Must know reasons to consider a 1% down mortgage? Struggling to save for a down payment? Learn about 1% down mortgages from leading lenders. Discover benefits, eligibility, risks, and more for informed homeownership. Saving up for a down payment can be a daunting task, particularly for individuals with limited savings or who struggle to save consistently. If you are constantly withdrawing what you have set aside, it may be an inadequate budgeting issue, or it could be an impulse spending issue. Either way, the savings balances are not substantial that you have managed to accumulate to work with. This may be good news for you. United Wholesale Mortgage and Rocket Mortgage, two of the nation's leading lenders, have introduced an enticing solution: loans that only require a mere 1% down payment. This 1% down program is a far cry from some programs requiring up to 20% down payments to qualify. While these loans may seem like an attractive opportunity, it's important to carefully consider their implications before deciding to proceed. Here are 5 compelling reasons why a borrower should seriously consider securing a 1% down mortgage if it is one of your options on the path to homeownership. A. Enhanced affordability. One of the most significant concerns when it comes to homeownership is affordability. Apart from the monthly mortgage payment, there are additional costs to consider, such as routine repairs and maintenance, which typically amount to 3–5% of the home's value annually. It's crucial to assess whether you can comfortably afford these ongoing expenses within your budget. Keep in mind that costs for maintaining a property can vary each year, and unforeseen factors like rising homeowners' insurance and property tax rates can significantly impact your finances. Therefore, before opting for a 1% down mortgage, thoroughly evaluate your ability to manage these additional costs over the long term. If your property insurance went up 40% in 1 year like it did to Floridians in 2023 after catastrophic storms, is this cost increase a budget breaker for you when your hypothetical $3,000 a year insurance premium increased to $4,200 a year? That would increase your monthly mortgage payment by another $100 a month instantly. If your property taxes followed the previous nationwide 5-year approximately plus 5% annual increases, how would that impact your overall cash flow? Would it be absorbable? On a hypothetical $300 a year property tax bill, a 5% increase would only set you back another $13 a month on a mortgage payment increase. B. Mitigating negative equity risks. In regions where home prices are declining, borrowers who make minimum down payments may find themselves in a challenging situation where they owe more on their mortgage than their homes are worth. But when you have little cash invested in the home overall, the sting of a declining market value may not be as painful as it is to your neighbor who put 20% down on an identical home when all their assumed equity at the closing table vanished in a short time from declining home values. This negative equity positioning can be problematic if you need to sell your home quickly or face unexpected financial difficulties that hinder your ability to make mortgage payments. If you do not see yourself moving for a long period of time, then the lower property value may recover over time, making the long-term effect of being underwater on a property for a few years unnoticeable when you sell the appreciated property many years later. I will add one caveat here: there is no guarantee any property will appreciate in value in time written within any property sales contract I ever read. C. Consider eligibility factors. While the allure of a 1% down mortgage is strong, it's important to recognize that not everyone with lower credit scores will qualify for these types of loans. Both United Wholesale Mortgage and Rocket Mortgage impose certain eligibility criteria, such as a minimum credit score of 620 and an income limit of 80% of the area median income. If this criteria represents where you are financially today, it may be a pathway to homeownership you never thought possible with a score too low to qualify for other mortgage-based programs. D. Reduced personal investment. With a minimal down payment, you have less personal equity invested in your home. Having a significant financial stake in your property can act as a deterrent to walking away from your home debt obligations during times of financial strain, even if it would be the most financially sensible step to take to let the property go back to the lender. If a 1% down mortgage reduces your personal investment, making it easier to abandon your property if cash flow problems arise, A divorce occurs and neither party can afford to keep the home with a sale not forthcoming, or property values decline, this low down payment scenario could be a good choice for your future financial well-being if walking away is contemplated. Walking away from a property with little to no equity can lead to severe credit damage and long-term financial consequences. You are not totally free from repercussions if you walk away. With a low credit score as your starting point, additional negative credit points lowering your credit score may make little difference to you overall in severe financial crisis situations. Heightened risk for lenders. Lower risks to borrowers. Someone assumes a measure of risk in every transaction. While borrowers may benefit from the low 1% down payment requirement, it's essential to recognize that lenders assume a higher level of risk. In most home loans, it is the borrower assuming the most risk when large down payments have been used to qualify for a loan. In a low down payment program, the risk is shifted to the lender who has put much more money into the property as a loan than normal loan-to-value protocols would. If borrowers become unable to make their mortgage payments, lenders may not receive delinquent loan payments until the home is sold. A short sale or other negative consequence is handled on a case-by-case basis. This increased risk for lenders can have broader consequences for the lending industry and potentially ripple effects throughout the nation if a significant number of borrowers default on their loans. History has shown us the devastating impact of reckless lending practices, as witnessed during the banking collapse of savings and loans in the 1980s. By taking a cautious approach to lending, we can learn from past mistakes. Or not. While a 1% down mortgage may initially appear attractive as an alternative for individuals where home ownership has always been out of reach for one reason or another, it's crucial to approach it with careful consideration and a thorough understanding of the potential financial risks involved that go beyond the low 1% down payment part of the borrowing equation. Home ownership goes beyond the initial purchase and requires ongoing financial responsibility. You may live in the home for decades or not. The affordability of homeownership, including the costs of repairs and maintenance, must be thoroughly evaluated. Additionally, the risk of negative equity and limited eligibility should be considered, along with the reduced personal investment and heightened risk for lenders. By weighing these factors and exploring alternative financing options, borrowers can make informed decisions that prioritize sustainable homeownership for the future. It is important to know your options. Remember, your goal may not be solely to acquire a home and cease renting, but to ensure your long-term financial stability and well-being as a separate and important goal to attain at the same time. If you found value in my content, please take a moment to clap, highlight, comment, and subscribe for more entrepreneurial content to build your wealth and business. Check out my educational YouTube channel playlists at www.youtube.com, My Profit Specialist Playlists.